The very first part of the course will be about understanding futures in order to better understand options. Here we will see basic concepts about derivatives markets, the major differences compared to other markets, contract specifications, leverage and risk, margin and management of the risk of insolvency, and the pricing. Lesson number 1, Introduction to Derivatives. Here, what you will learn in this lesson. What are derivatives? What makes derivatives different from other assets? And what is the role of the buyer and that of the writer? This is a very important concept, which we will see very soon. Some introductory notes on derivatives. Derivatives are quite complicated instruments. They are called that way because the behavior of a derivative contract derives more or less closely, depending from case to case, from that of another asset named underlying. Trading in derivatives attracts many investors, first of all, thanks to the high intrinsic leverage of these instruments, which allows to reach high gains with small money amounts. But pay attention, because the leverage works in the same way in both directions, and this means that if you're on the wrong side of a trade, your losses could be very, very high. These instruments demand then for a deep knowledge, both in terms of risk-reward profiles and the ways to manage open positions. Difficulties in the field of derivatives arise from 7 sources, which we will see in full details going forward. They have a maturity at which they cease to exist and are replaced by new contracts. At maturity, they can involve cash settlements or physical settlements, depending on contract specifications. The purpose of trades held till the maturity is completely different from that of short-term trades. One first very important note, derivatives have maturity, but it doesn't mean that in the moment you purchase them, you have to keep them till the maturity. You can buy and sell, buy and sell, buy and sell them multiple times, even in a single day, hour, or minute. So I was saying that the purpose of trades held till the maturity is totally different from that of short-term trades. Usually, short-term trading on derivatives is pure speculation. Trades held till the maturity on a futures contract or on option contract may have also hedging purposes, hedging of risks of some sort. The intrinsic leverage of derivatives demands for a strong risk management based on a daily regulation of profits and losses according to a set of rules which we will see. Every open contract in the market is made of 2 active counterparties having opposite expectations. This is one of the main differences between derivatives and other assets. A very important difference, which we will speak a lot about. Pricing of derivatives changes according to the nature of the underlying. Later on, we will see how prices of futures are made, and we will see that, just to say, a commodity futures price is much different from the stock futures price or a stock index price, because the rules that decide the price of each single contract are very different from case to case. Prices often follow dynamics not completely explained by market variables, and this happens especially in the field of options, as we will see. Let's speak of the role of the buyer versus the writer. Generally speaking, in the field of standard financial products such as stocks, bonds, ETFs, and the like, any trade involves a buyer who gets into a position and a seller who gets out of it. The buyer opens a long position, the seller had a long position and now is getting out, is flat. In the field of derivatives, things are quite different. In a trade on a futures or an option, indeed, any contract opened in the market is always made by a long and a short position both active at the same time. The buyer who goes long expects a price increase. The seller who goes short expects a price reduction. Let's give a quick look at the note on the bottom of the page. To be stringent, things are quite more complicated in the field of options, but this is not the right time. So for now, let's say that the buyer expects a price increase. The seller expects a price reduction. That's it. In a few words, a derivative contract exists thanks to two counterparties concurrently active, one on each side of the wall, and of course with opposite expectations. Derivatives can be purchased, sold, short sold, both to cover multiple times, even in the same day, hour or minute. Indeed, they can be transferred to anyone in the market with just a single mouse click. Trades can last even just a few seconds. As I said before, in the moment you purchase a futures or another derivative, you do not have to keep it till the maturity. Short selling of a futures or an option is itself much easier and faster than the short selling of a stock. No borrowing is needed, no extra costs come into play. You just need to click on the sell button instead of on the buy button. Any contract in the market then is always made of two counterparties given of different expectations about the future trend of the underlying. These opposing expectations end up in specular profits and losses. The derivative game, in fact, is a zero-sum one. Let's speak of transfers of existing contracts. We will first see it in words, and then in the next slide we will see it with a scheme that should make things easier to understand. Since derivatives can be transferred to anyone in the market just selling or buying them, the buyer and the writer of any contract are not bound together by an indissoluble contract. If, for instance, Mr. Brown purchases a futures contract on the S&P 500 index and Mr. Smith sells it short, and after a while, even just a few seconds, Mr. Smith wants to get out of the trade, he has no need to meet again with Mr. Brown in the book. Indeed, Mr. Smith just needs someone else willing to take over that same trade. Anything Mr. Smith needs to do is to open the book of the S&P 500 index futures and buy it back in order to close his short position. He is short to get out, he just needs to buy it back. Now imagine that Mr. Johnson is in the first line of the book in that moment on the ask side. He is trying to sell, so it could be the counterparty of Mr. Smith. Mr. Smith needs to buy, so he needs to find someone willing to sell. Mr. Smith buys a futures contract from Mr. Johnson. Mr. Smith is now flat because he was short, he buys, then he is flat. Mr. Johnson is now short, and he has become the new counterparty of Mr. Brown. Now, let's assume that after a while, Mr. Brown wants to get out of the trade. He is the one on the long side of the contract. Imagine Mr. Williams is in the first line of the book on the bid side. Because Mr. Brown is long, in order to get out, he needs to sell. So he has to look to the bid side of the book. Mr. Brown sells his futures contract to Mr. Williams. So Mr. Brown is now flat, Mr. Williams is long, and he is the new counterparty of Mr. Johnson. All of this is possible because a futures contract is listed on a regulated market. So you have a book, and everything you need to do is open the book and click on the proper side of that. What usually happens then is that any time a trader gets out of a trade, the contract does not cease to exist. It is just transferred to someone else. A contract is totally closed only when a buyer and a writer concurrently active in it close their positions between them, at the same time, of course. Let's see the same concepts with this scheme. We indicate long positions with the sign plus and the green font. Short positions with the sign minus and the red font. Flat positions are in black. In the beginning, the situation is this. Mr. Brown goes long, +1, green. Mr. Smith goes short, -1, red. Mr. Brown and Mr. Smith just created, just to say, so to speak, a new contract in the market. After a while, Smith wants to get out. He needs to buy back the futures contract. He opens the book, then finds Mr. Johnson on the ask side, hits Mr. Johnson. The situation is then the following. Mr. Brown is still +1. His situation is not changed. Mr. Smith was -1, now is doing +1. His net position is 0. He is flat. He is out. Mr. Johnson is -1, the new red side of the contract. The short side of an existing contract has been transferred from Mr. Smith to Mr. Johnson. Now, assume that at some time later on, Mr. Brown wants to get out. He is long, he needs to sell. He opens the book, finds Mr. Williams on the bid side. As the trade takes place, the situation among them is this. Mr. Brown is +1, -1, so he is now flat, 0. No longer positions opened. Mr. Williams is now +1, green. So the futures contract is always the same, but the two counterparties changed. Now we have Mr. Williams on the long side, +1, green, and Mr. Johnson on the sell side, -1, red. So conclusions of all the things said in previous slides, the very important concept to become familiar with in the world of derivatives is that for every open contract, there are always two actors active simultaneously. Only one of the two will close the position in profit, and that profit will mirror the loss for the counterparty. This is very different from what happens in the field of stocks, just to say. If you purchase a stock, after a while the price goes up and you decide to settle down, you take the profit, you sell it, and the price keeps going up. You are not suffering losses, you are just missing more profits. In the field of derivatives, things are much different because in an open contract there are two counterparties, both active at the same time. So one is gaining money, the other one is losing money. And what someone gains is exactly the same amount someone else is losing. We will come back to this concept when we will talk about the margining mechanisms and rules that govern the optimal risk management of derivatives markets. For now, that's all. Thank you for your attention.